Yes, so we are going to look at this particular question here. So confirm whether you are there, because I want us to begin. I want us to begin with that illustration. That is September 2015 question number 1. So confirm whether you've gotten the question, whether you are there, because I want us to begin immediately with that illustration. So through the chat, you can be able to confirm whether you have the question. Through the chat, you can be able to confirm whether you have the question. So September 2015 question number 1. So confirm whether you have the question so that we can begin. So no one asked the question. I don't know whether you have the question. No one asked the question. No one asked the question. So I'd already shared the questions. You should be having them. So confirm. We need to begin. Thank you. I can see Irene says I have. Nekesa says I have. What about the rest? I can see Ruth says I have. Ruth says I have. Who else? Who else has the question? Who else? I got it. I can see Gideon says I got it. I got it. I got it. So we can look at this particular question. It will be able to help us in this case now better off comprehend what we looked at as part of the key adjustments whenever in this case you are consolidating what financial statements for a holding company and a subsidiary company. And of course, you need to be very keen as to what is going to happen in this question, because I can tell you, if you're not very keen, you'll end up having to get confused in between. So just be very keen as to what is happening each and every step, so that in this case, we can be able to move together. Because if you don't comprehend this particular illustration, then you'll have a lot of challenges in terms of even being able to handle the other illustrations. Or maybe as we move forward, you'll be wondering what are some of these entries you're having to make. So we'll go through the question. Then in this case, of course, you can be able to do the necessary workings and adjustments. Then we'll be able to prepare the necessary final statements as required by the examiner. So the question reads like this. So on 1st of October 2014, P Limited acquired 60% of equity share capital of S Limited in a share exchange of 2 shares of P Limited for 3 shares of S Limited. So this means in this case, P Limited is the holding company, and of course, S Limited is what is the subsidiary, On this date, the shares of P Limited were trading at 8 shillings. So on this date, they were having to buy these S Limited on the stock exchange, or maybe the market price of the shares of this S Limited were at what? At 8 shillings. Below are the financial statements of the 2 companies for the year ended 31st of March 2015. So you've actually been provided for the income statement for the 2 companies. That is the holding company, which is P Limited and S Limited. So you have the revenue, cost of sales, gross profits, amongst other details pertaining to what? To the income statement. We also have the statement of financial position for the 2 companies. That in this case, for P Limited, we have the non-current assets, and of course, S Limited non-current assets. So we have property, investment, property, current assets. We have inventory, receivables, and of course, what? Bank. Equity and liabilities, we have in this case the capital and reserves. We have the ordinary share capital, and of course, the retained earnings reserves. We have non-current liabilities, that is 10% loan notes. Current liabilities, we have trade payables and accruals. You've actually been given the additional information. So hapa sasa ndio kuna mambo. We can go through them. Then of course, in this case, we'll start what the workings and see what are some of the key adjustments we need to be able to make pertaining to the additional information. So the issue of shares on acquisition of S Limited has not yet been recorded by P Limited. So you can see in the first paragraph there in the question, on 1st of October 2014, P Limited acquired 60% of equity share capital. So they're having to say this one has not actually been accounted for. We need to account for it. We need to account for it by passing what? Necessary entries or journal entries to complete what? The acquisition. Then note number 2, as at the acquisition date, fair values of S Limited assets were equal to their carrying amount, except for an item of plant which had a fair value of 2 million in excess of the carrying amount. So of course, if you look at what we wrote as the last item under the special adjustments, we talked about what revaluation of assets. Revaluation of what? Of assets. So this is what they're having to talk about here. So the plant had a remaining useful life for 5 years as at the acquisition date. S Limited has not revalued its assets. So they haven't, for example, captured this revaluation. So we have to account for it on what? On consolidation or on acquisition of what? Of this subsidiary. So sales from S Limited to Patterson Limited in the post-acquisition period amounted to 8 million. That's what we refer to as what? Intercompany sale. Intercompany sale. So S Limited made a markup of 40% of 2.8 million of these goods at cost of P Limited was still included in what? In inventory. When you hear this statement, what did we say you must actually be able to think about? They're having to say in this case, S Limited made a markup of 40%, 2.8 million of these goods at the cost of P Limited was still in inventory. What are they calling upon you to compute here? We said when you hear about this statement, what are you need to be able to think about what? URP. URP. What is that? Unrealized profits. So whenever you hear this statement, they want in this case to think about unrealized profit on what? On the closing inventory. Then S Limited trade receivables include 800,000 due from P Limited, which did not agree with the corresponding payables. This was due to cash paid by P Limited, which was yet to be received by S Limited. So this is what we refer to as what? Intercompany balances. Intercompany balances. How did we say we treat intercompany balances? Intercompany outstanding balances. Which entries do we pass? S Limited trade receivables include 800,000 from P Limited. It means one of them was actually what? Was actually a trade receivable to the other. The other one was a trade payable to the other one. So you deduct. But what are you deducting, Missy? You need to tell me. You need to tell me. Of course, in this case, I was having to tell you pass some entries. You debit what and credit what? You debit payables and you credit. You debit payables and you credit. You credit receivables. You credit receivables. It's in this case, ideally, you're having to say you deduct. So, of course, in this case, it means what you mean that you deduct from the trade payables and also deduct from much from the trade receivables. So, but of course, there's something here which I mentioned towards the last sentence of that statement. There can be what we call what? Cash in transit, which in this case, you have to account for it. But of course, I'm going to tell you what will happen with this cash in transit when you come to that adjustment. But of course, just know that is what? An intercompany balance that's supposed to be eliminated, but there can be a cash in transit element that can be in. So how do you account for it? So we are going to see when in this case, we handle that particular adjustment. So P Limited has a policy of accounting for any non-controlling interest at fair value. Fair value of goodwill attributable to non-controlling interest was actually valued at 2.4 million. 2.4 million. So sometimes in the exam, you know, in this case, I told you there are two methods of having to compute what? Goodwill. I told you in this case, you have what? The full goodwill method. Full goodwill method. I told you we have the full goodwill method and we have the partial goodwill method. The partial goodwill method. So I told you there are two methods of computing what? Goodwill. So you have in this case, the full goodwill method and you have the partial goodwill method. So with this one, I was having to indicate that on the acquisition of the subsidiary, we'll likely consider the goodwill of the holding company and that goodwill of what? Of the subsidiary. The goodwill of the holding company and that one of what? Of the subsidiary. And of course here, you've actually been given the goodwill. So fair value of the goodwill attributable to non-controlling interest. What they mean by non-controlling interest here, remember here, the acquisition is actually what? 60%. So it means what this holding company is not able to control is actually what? 40%. This is what I told you is what? The non-controlling interest. The non-controlling interest. Or in this case, what we mean, the interest of the minority. These are the minorities. What they are controlling in this company is 40%. What the holding company is having to control is 60%. What the minority are actually controlling is what? 40%. That's what we refer to as what? The non-controlling interest. The reason why it is non-controlling is because they're not able to control. They're not in the majority. These are the ones who are in the majority in terms of the shareholding. They are controlling, but these ones are not controlling because it is in the minority. It is actually what? In the minority. And then in this case, when you are doing the consolidation, we normally consider the goodwill attributable to them. We normally consider the goodwill attributable to them. And that's why in this case, when we are talking about the full goodwill method, we said is whereby in this case you end up having to consider the goodwill of the holding company, and of course that one of what of the subsidiary. So here what it means, we likely end up having to compute the goodwill to the holding company, and of course in this case we add also this goodwill which have actually been given. Another thing to be able to take note of, in this case, the examiner won't actually tell you directly that use the full goodwill method to compute the goodwill. But when you reach a particular point in the additional information, they can talk about the non-controlling interest fair value is maybe in this case what? 500 million. Ukiona tu wamesema non-controlling interest fair value, wanataka unitumie hii method. And this is the most common. It is the most common in the exam. So watakwambia, the non-controlling interest fair value is what? In this case, maybe 500 million. Or like in this case, in our situation, they have already computed the goodwill on the non-controlling interest. The goodwill on this fair value of non-controlling interest, they have already been able to give you the figure. They have already been able to give you the figure. But in any case, you in the exam, ukiona tuko additional information, wamekuandikia hapo non-controlling interest fair value. They want you in this case to use what? The full goodwill method to do what? To compute the goodwill. But in this case, I told you, you'll take the purchase consideration, you add the non-controlling interest, you less what? The net assets. The net assets like that. But of course, in this case, they haven't given you this. They have given you already the goodwill computed on this. The goodwill computed on this. So in this case, what it means, you'll be able to get the goodwill that in this case is attributable to the holding company. Then you'll end up having to add the goodwill, which now in this case, you've already been given or what of the non-controlling interest. Of course, you're going to see when I do the working, you'll be able to see what is happening. But what I want you to get, you need to get into your head. Ukiona kwa exam wamekuandikia the additional information that the non-controlling interest fair value was 6 million automatically. You need to use the full goodwill method. In fact, if you want to compute goodwill, tafuta hiyo kitu kwa additional information kama iko. Kama iko, in this case, you'll end up having to use what you call the partial method. The examiner won't tell you. They'll just tell you, for example, in this case, the non-controlling interest fair value on the date of acquisition was valued at 600. It means that is the figure. You know, in that particular formula, that presentation we said, you take the purchase consideration, you add the non-controlling interest fair value. That is the figure you'll use here. You add the purchase, then you consider the net assets. So that you can be able to get what? The full goodwill that in this case, they'll be able to apply in terms of what? Preparing what? The statement of what? Of financial position. So in our situation here, you've actually already been given what? The goodwill on this non-controlling interest. You haven't been given the fair value here. You've been given the goodwill. So we'll in this case, compute the goodwill that is attributable to the holding company. Utaona vile tutafanya. You need to be keen when I'll be doing that. Then in this case, we'll be able to add this goodwill so that we get the full goodwill that will be able to, in this case, recognize in the statement of what? Financial position consolidated, because goodwill in this case will likely be considered as part of the non-current assets in our consolidated what? Financial statements. That is of so much importance. You get that. So you're having to be told, P Limited has a policy of accounting for any non-controlling interest at fair value. Fair value of goodwill attributable to non-controlling interest of S Limited was 2.4 million. So already you've been given goodwill of this. Sometimes they just give you, they'll tell you the fair value of the not goodwill, but the fair value of the non-controlling interest is maybe 10 million. So they, in this case, they want you in this case to compute what? The full goodwill by considering it 29. In this case, you are computing what? These ones. So the purchase consideration, you add that, you less the net assets, and of course, you'll be able to get what? The full goodwill to be applied as the asset. So neither of the company declared dividends in the year ended 31st of March 2015. So, and in this case, they want you in this case to prepare the consolidated statement of comprehensive income as of 31st of March 2015. Then the consolidated statement of financial position as 31st of March, what? 2015. So in this case, we can actually start in this case, the workings. And of course, in this case, as I told you, I want you to be very keen. I want you to be very keen. If you look at the first statement of so much importance, you need to be able to, in this case, identify the date of acquisition. It is very important. Very important. The end of the year and the date of acquisition is very important because you'll be able to know. Because I told you some of the expenses, some of the computations will basically require you to apportion. And of course, if you don't know when the date it was acquired, what is the end of the year, you won't be able to know in this case exactly as to how you'll be able to apportion. So in our situation here, you've actually been told that in this case, we need to prepare the financial statements for the year ended 31st of March 2015. So in this case, Our year is actually having to end 31st of March, in this case, 2015. 31st of March, in this case, what, 2015. 31st of March, 2015. And therefore, in this case, the acquisition happened when? On 1st of October. So of course, this means the start of day in this case is actually 1st of April. 1st of April, 2014 is 1st of April, 2014. The acquisition in this case happened on 1st of October, 1st of October, 2014. So this is when they acquired what? S. Is when they acquired S. Is when they acquired S. And of course, in this case, the acquisition is basically comprised of how much? 60%. So in this case, you have P acquiring S. So how much? 60%. 60%. 60%. It means it was acquired here. So the subsidiary consisted basically was part of the group for how many months? 6 months. Sindio? 6 months. 6 months. So this subsidiary was only part of the group for 6 months, because if you count October, November, December, January, February, March. So that is how many months? 6 months. So it means anything that happened before this particular date is what now in this case we refer to as what? Pre-acquisition. Moving backward, anything beyond that is actually pre-acquisition. Of course, very important, because this particular apportionment of the year will actually enable us to be able to know when we'll be apportioning the expenses for the subsidiary. When you are consolidating, will take only for how many months? 6 months, because it existed as part of the group for only how many months? 6 months. Also, in this case, when we'll be computing what? The pre-acquisition what? Profits. This one will likely be very important, because it will enable us to be able to know how much were the pre-acquisition profits, what were the post-acquisition what? Profits. And of course, you're going to see how we'll end up having to use that. So that is actually very important. You take note of the dates when it was actually acquired, how long the subsidiary existed in the group, because you'll do the apportionment of what? Of the expenses when you come to what? The statement of comprehensive income. So that is actually very, very important. Then in this case, as per note number 1, you've been told the issue of shares on acquisition of S Limited has not yet been recorded by P Limited. So they are yet to record this. They're yet to record this. So we need to account for this. So what you're having to be told here, on 1st of October 2014, P Limited acquired 60% of equity share capital of S Limited in a share exchange of 2 shares of P Limited's 3 shares. So in this case, what they mean here, it is that this acquisition was, in this case, they're having to say, share capital of S Limited in a share exchange of 2 shares for P Limited's 3 shares. So in exchange of 2 shares for P Limited's 3 shares. So it means in this case, for every 3 shares in S, in this case, it means they were having to get how many shares? 2 shares. They were having to get how many shares? 2 shares. That's what they're having to say there. So equity share capital of S Limited in share exchange of 2 shares of P Limited, 2 shares of P Limited for 3 shares of S Limited, So in this S Limited, this P was giving out 2 shares as they get how many shares? 3 shares. As they get how many shares? 3 shares. So you need in this case to know how many shares they got from S Limited. When they gave them the 2 shares, how many did they actually end up having to get? How many did they actually end up having to get? And of course, if you look at the equity part of the statement of financial position, you can be able to see their ordinary share capital of shillings 1 each. And of course, in this case, S Limited ordinary share capital is 8 million. So this means how many shares do we have in S Limited? How many shares do we have in S Limited? How many shares do we have in S Limited? How many shares do we have in S Limited, according to you? How many shares do we have in S Limited? I can see you're saying 8 million, 8 million, 8, Valadi says 8 million. So we have in this case, how many shares? 8 million. That is very correct. So in this case, you can be able to indicate our workings. So working 1, our workings are in shillings of thousands. So shillings of thousands, actually in thousands, in shillings of thousands, or maybe thousands. So that is 8 million shares. 8 million shares. I can be able to see you're not seeing there. You're not seeing there. I think there it will be better. There it will be better. So in this case, we have, so for every 3 shares in S, they were having to give them 2. They have every 3 shares in S, they were having to give them how many? 2 shares. How many shares? 2 shares. So we want in this case to compute how many shares they got from S. How many shares they got from S. So in this case, we'll do the cross multiplication here. And of course, we'll have in this case 8 million multiplied by 2 divided by 3. How much do you get as the number of shares acquired? How much do you get as the number of shares acquired from S? You get 5333. You get 5333. 5333. Is it 5333? 5333. 5333. I can see you're saying 5333, but there's something you haven't done. So in this case, we need to, they're having to say that they acquired 60%. So we have to do 60% of this. 60% of they acquired only 60%. So 60% of this. So shares acquired, you can correct here, shares, share capital, the portion of shares acquired. So the shares acquired is equals to 60% multiplied by 8 million. So it will likely be equal to 4,800,000 shares. So it means in this case, the only portion they acquired out of the total equity of 8 million, so you can correct here, it is supposed to be 48. Supposed to be 48. So it means in this case, they only acquired, in total, they acquired 4,800 shares because they acquired 60% of the total equity or total ordinary share capital. The remaining 40%, that is in this case, the difference, that is 3,200,000 was going towards non-controlling interest or the minority. So in this case, it will be 4,800. Then in this case here, for us to be able to know how many shares they ended up having to get, it will likely be 4,800. So they acquired 60% in that exchange. So it will be 4,800 multiplied by 2 over 3. So I think you can be able to get the correct figure. So you'll get how much? 3,200. 3,200 shares. 3,200 shares. So they did what we call a share exchange. They did what we call a share exchange. So in this case, it means for every 2 shares, of theirs as P Limited, they were getting 3 shares in S Limited. In total, the number of shares they got from S Limited was 4,800,000. They acquired 60% of the equity capital. 60% of the equity capital. In this case, in the share exchange, they ended up having to get how many shares? 3.2 million. 3.2 million. But now you are actually told that on the date of this acquisition of these shares were trading at 8 shillings per share. 8 shillings per share. They were trading at 8 shillings per share. So it means if we convert these shares into worth of money, they would have paid. If we convert these shares into worth of money, they would have paid. It means in this case, you have to multiply by how much? 8 shillings. Shillings 8. So in monetary worth, it will be 3,200 multiplied by 8. In short, they did a share exchange. So they were donating shares as they get also what? Shares. They were donating shares as they also do what? Get shares. So the shares they ended up having to get in that share exchange was 3,200,000. But at that particular point in time, they were doing the share exchange. These shares, the market price was actually having to go at 8 shillings. So assuming they had purchased, it means they would have paid these S Limited an amount worth of 3.2 million of shares multiplied by 8. Multiplied by 8. So you'll get how much? How much do you get there? You get 25,600. So 25,600. 25,600,000. So this one will likely end up having to be like, in this case, what? The purchase consideration. This is what they would have been able to pay if in this case they were having to do what? Buy these particular shares of the company at that particular point in time. But now, as per note number 1, the issue of the shares on acquisition of S Limited has not yet been recorded by P Limited. So in this case, we need to do the journal entries to complete that. It means that becomes the purchase consideration, which in this case will debit the purchase consideration account. Will debit the purchase consideration account. In this case, by how much? 25,600,000. But remember, these shares their value was supposed to be 1 shilling, but in this case, they were having to go at how much? 8 shillings. So there was an amount over and above this 1 shilling, which now in this case, we normally refer to as what? As the share premium. So the par value of these shares, if you look at the books of accounts, the par value is 1 shilling, but they were supposed to pay how much? 8 shillings. So that was the market price. So they were trading at 8 shillings. They would have paid 7 shillings beyond the par value. Any amount beyond the par value, we normally refer to it as what? As the share premium. So it means in this case, in our situation here, the account to be able to credit, of course, will credit the ordinary share capital. Ordinary share capital. Ordinary share capital. In this case, we'll take the number of shares acquired, which was 3.2 million. We multiply by the 1 shilling, which is the par value. In this case, it means in the ordinary share capital, they ended up having to get 3.2 million. But now, in the share premium account, there was that amount over and above the par value. So in the share premium account, there was that amount over and above the par value, which in this case, it will likely be, of course, 3,200. You multiply by 7. So in total, you'll get 8 shillings because this is what they acquired. They were supposed to pay for the shares, but now the par value is this one. This one goes to the ordinary share capital. The extra amount over and above goes to the share premium account. It comes to how much? 22,400. 22,400. And of course, if you add, they're supposed to add 25,600. So what it means by this particular purchase consideration here, it will help us to compute what? The goodwill. Because when you are computing the goodwill, you take what? Purchase consideration less the net assets like that. So we'll use this one in the computation of the goodwill. These ones, they likely be part of the items. They likely be part of the items. When in this case, we are coming up with what? The statement of what? Financial position. So they'll be part of what? The equity items. When you are coming up with what? The statement of financial position. Which means this one will end up having to add it on the ordinary share capital of the holding company, when we'll be coming up with the consolidated what? Financial statement. This one will appear as part of the equity items, but now in this case, it will be the share premium of the group. Share premium within what? The group. Share premium within the group. And of course, that is basically, in this case, you'll end up having to deal with that, what? The acquisition there. Then note number 2, if you look at note number 2, as at the acquisition date, so that is actually, of course, what we can say working 2. And say working 2. So working 2. So my board has an issue. So you can do working 2. So I'll try to write very small. Hope you'll be able to see. So working 2. So we can go to working 2. So they are saying as at the acquisition date, fair values of S Limited assets were equal to their carrying amount, except for an item of plant, which had a fair value of 2 million in excess of the carrying amount. The plant had a revaluation useful life of 5 years, as at the acquisition date, S Limited has not revalued its assets. So in this case, we'll have working 2. So working 2, we'll have the revaluation reserve. In this case, we have a revaluation of plant of 2 million. Revaluation of plant of 2 million. So in any case, there's this kind of a revaluation. It means what will happen, we'll likely debit, of course, in this case, what? We'll likely, of course, debit the property, plant, and equipment within this case, how much? The 2 million. We'll likely credit the revaluation reserve by the 2 million. So what it means in this case, there was an item of plant. On the acquisition, they revalued it. Maybe it was 6 million. They revalued it to 8 million. So when you are consolidating, we have to consider, because what will happen, it will increase the value of what? Property, plant, and what? Equipment. When you debit, you're increasing what? The value of property, plant, and actually what? Equipment. At the same time, it will increase the revaluation reserve of the subsidiary. And of course, you'll be able to see this one, we'll be able to consider it when you'll be coming up with what? The goodwill. Utaona too. So you have to take note of that. Still on the same note, in this case, as a result of revaluation, there'll be depreciation adjustment. So you have to consider in this case, what was the value of depreciation on this asset After they had actually done what? The adjustment. After they had actually done what? The adjustment. So in this case, you are told that the plant had a remaining useful life for 5 years as at the acquisition date. So in this case, you have to consider depreciation on revaluation. Depreciation on revaluation. It will affect the depreciation once they revalue the assets up. In short, it will increase what? The depreciation. So in this case, it means we'll have to use that useful life. So if it is 2 million, it will still exist for 5 years. So each and every year, it will likely lose that 2 million divided by 5. That 2 million divided by 5. So 2 million divided by 5. But of course, now in this case, it was for how many months? It was only for how many months? 6 months. It was only for how many months? 6 months. That's why I told you it is very important you remember 6 months. So after the date of acquisition, of course, per annum, it will be 2 million divided by 5, but this subsidiary will be in existence as part of the group for only 6 months up to the end of the year. The essence of us having to know when was it acquired, because some of the expenses we end up having to do what? Apportion. We end up having to apportion, one of them being this one. So how much are you having to get? You're having to get, in this case, how much? 200,000. 200,000. 200,000. 200,000. Remember, once this revaluation has actually been done, it means depreciation has increased in the subsidiaries' operations. It means in this case, what will happen here? You know what normally happens with it? It normally reduces the values of the assets. It reduces what? The values of the assets. So what will happen with this one? It is that we likely end up having to do what? Debit. We likely debit the expenses or depreciation expense. But of course, what normally happens here, because there is no that specific expense for depreciation, we'll end up having to debit the cost of sales. Then in this case, we'll end up having to credit, in this case, what? The property, plant, and equipment. In short, what you're having to say, when you'll be consolidating, of course, you'll be adding the assets of the holding company and subsidiary. But now, because after revaluation, depreciation ended up having to go up because of the revaluation, we'll have to less it. We'll have to less it, because what will happen, you know, in this case, you've been given property, plant, and equipment of the holding company. That is how much? 6,900 and 8,900. Because this one has ended up having to arise, we'll have to minus that one because they not actually considered it. The same time, in this case, we'll have to add this one because it is increasing what? Property, plant, and equipment. Ideally, what we'll do, we'll take 60,900,000 as per the statement of financial position there, plus 18,900. We add this one. It was revalued. We less this one because it is depreciating the asset, reducing it. That's basically what we mean by when we talk about having to do what? Debit PPE, credit revaluation. Then, of course, the depreciation on that revaluation, we debit the cost of sales as part of the expense because we normally consider depreciation as what? As an expense in the business. Then we credit what? Property, plant, and equipment. Ideally, what we'll be doing here, we'll be reducing PPE when we'll be consolidating. So, tukifika hapo utaona mwalimu amesema, take 60,900,000, add 18,900, add 2 million, then less this one. We'll be doing the necessary adjustments for the consolidation what? Process. So in any case, you have a revaluation. This is how you basically deal with it. It will increase the value of the assets, but you have to consider the depreciation on that what? Revaluation. It will affect the value of that plant still at the same case, just in the same account, but now it will increase the expenses. Where do you consider it? In the cost of sales. You add it. You add it because it is an extra expense. Exactly what? An extra expense. An extra expense. Hope you've gotten that. So in this case, we go to note number 3. Note number 3. Note number 3. So they're having to say, so that is working number 3. Working number 3. Working number 3. So they're having to say, sales from S Limited to Patterson Limited in the post-acquisition period amounted to what? To 8 million. S Limited made a markup of 40%. 2.8 million of these goods at cost to P Limited were still included in the inventory as of 31st of March 2015. So in this case, you have what you call what? Intergroup sale. An intergroup sale. An intergroup sale. Intergroup sale. Intergroup sale of an amount of 8 million. 8 million. What do you think we'll do with this one? What will we do with this one? You can try. You need to also think as to what we learned. You'll debit sales. You'll debit sales. Then you debit sales, then you credit cost of sales. Or in short, what do you mean in this case? Valerie, instead of using a difficult language, what else can you be able to say? You'll debit sales, so you'll end up having to debit sales. Or in this case, you can just be able to write. So you'll debit sales, debit sales, you credit cost of sales. In this case, what you mean by this, you less from sales, and also in this case, you less from cost of sales. So this is what we'll end up having to deal with these ones. So don't forget, so deduct from both of them, Then you are told that S Limited made a markup of 40%. So there's what in this case, what you're calling what? A markup. What did we say when you are given a markup you do? So the markup was 40%. What did we say when you are given a markup you do? You convert to a margin. You convert to a margin. You convert to what? To a margin. You convert to a margin. So therefore, in this case, it means the margin will be in this case 40. Will likely in this case be 40% over 140%. So like that. Because this one is over 100. So we said in this case you take. Hope you can be able to see here. So if the markup is 40, it means this one is 40 over 100. In short, what we mean in this case, to convert to a margin, it will be 40 over 100 plus 40. Ama unaweza fanya ikuwe fraction, but you can easily do it like this. Sawa. Unaweza fanya ikuwe fraction vile unataka. Basa badala uanze cancel, you can just say 40 over 140%. So 40 over 140, that will be in this case be what? Will be the margin. And then in this case, we can be able to compute the URP, the unrealized profit on these items that were still in stock. So the unrealized profit in this case will likely be how much? Will likely be 40 over 140. You multiply by, in this case, by 2.8 million. 2.8 million, I think 2.8 million. So what are you having to get when you do 40 over 140? So I can see Faith had reduced it to 2 over 7. No problem. You just get the same answer. So what do you get when you do 40 over 140 by 2.8 million? What do you get as the URP, then the unrealized profit? What do you get? You get 800. You get 800. So the URP, you get 800. The unrealized profit, you get 800. This unrealized profit, we said, there is how you deal with it. Maybe someone can be able to try. So the unrealized profit, how do you deal with it? On the closing stock, the unrealized profit on the closing stock. Unrealized profit on the closing stock, the URP. You'll add where? You'll add where? You'll add where? You'll add on the cost of sales. So of course you'll debit the cost of sales, and you credit what? You credit the cost of sales, and you debit the cost of sales, and you credit which one? The closing stock, or basically in this case, the closing inventory. In short, what we mean by this, you'll end up having to add it on the cost of sales, then you less on the closing inventory. So you have to always remember. So sasa ile tutakuwa tunatengeneza statement of comprehensive income. Unajua ukienda hapa kwa statement of comprehensive income, utapata wamekupatia cost of sales ya hizi kampuni mbili. Utapata wamekupatia cost of sales ya hizi kampuni mbili. Wamekwambia cost of sales ya P ni 126 million. Ya S Limited ni 64 million. So vile tutakuwa tunazicombine, lazima tukumbuke kwamba in this case kulikuwa na URP. So we'll add this 800. Sawa. We'll add this 800, tukuje pia to add hii 200 yetu hapa. So always know where is it going to affect. When you'll be combining them, you have to consider them. So we'll add this one to add hii. So unaona zina affect your cost of sales. So lazima tutazi add hapo. So you have to always in this case consider that. Consider that. So that is in this case how you'll be able to deal with that what URP, how you'll deal with that URP of 800. So you can in this case go to the next one. You can go to the next one. So in this case, that is trade receivables, intercompany balances. We can go to the trade receivables there. We can go to the trade receivables there. So you are told that is not number 4. S Limited's trade receivables include 800,000 due from P Limited, which did not agree with the corresponding payables, with the corresponding what? Corresponding payables. So that is working number 4. So that is what? Intergroup balances. Intergroup balances. Intergroup balances. Intergroup balances. Intergroup balances. So in this case, this what happened here. So S Limited trade receivables include 800,000 due from what? P Limited. So it means one of the companies here is a trade payable to another one. The other one is a trade receivable to another one. So S Limited trade receivables include, it means this S Limited was having to claim 800,000 from P. So in the trade receivables of S Limited, that is the subsidiary, they are claiming 800,000 from what? From P Limited. And of course, for this one, we said you do what? You eliminate. The intercompany balances you eliminate by having to do what? Deduct that amount from the trade receivables and also deduct from what? From the trade payables. But in our situation here, there's an element of what we refer to as what? As the cash in transit, as the cash in transit. So in this case, S Limited trade receivables include 800,000 due from P Limited, which did not agree with the corresponding payables. This was due to cash paid by P Limited, which was yet to be received by S Limited. That's what we refer to as what? Cash in transit. There was what? A cash in transit. So of course, the trade receivables of S Limited will in this case have actually will be more by 800,000. The trade receivables of this particular S Limited will likely be more than by what? By 800,000. Will likely be more than by 800,000. But for the trade payables of P Limited, it means they had already done what? The adjustment, because the cash is actually what? In transit. The cash is actually what? In transit. Of course, I told you in this case to eliminate them, you'll do what? You'll debit in this case what? You'll debit in this case the payables. I told you to eliminate them, you'll debit the payables. Then you credit in this case what? The trade receivables. The trade receivables. The trade receivables. But now, you know what has happened here? So this other company, that is S Limited, they are still considering this what? This payable, this particular amount owing from the other company as what? As a receivable. So of course we'll be able to eliminate. We'll eliminate it by having to do what? Credit it there. But these ones, they have already dealt with it because there's already a cash in transit. There's already what? A cash in transit. That in this case has to be received by what? By S Limited. That has to be received by S Limited. So this other company has already accounted for it. Remember, it is a payable in that other company. But how was lipa? So it is no longer what? In this case, what? A payable. It is not appearing there. So we can't eliminate it. But now in this case, we'll end up having to consider what? The cash in transit. We'll debit the cash in transit because ini pesa iko kwa njia inakuja. So ideally, it will likely end up having to increase the cash for both companies. But now we don't actually refer to it as cash in hand, or in this case, cash at the bank. It is cash in transit. So in this case, we'll debit the cash in transit. In this case, we'll likely end up having to appear as an asset in our consolidated financial statements. Is ideally because they had paid for this money na ikonjiani inakuja. So they have already eliminated it in the payables of that other company where they had reported it as what? As a payable. But they have paid it already. They have paid it already. So in this case, we won't debit the payables here, but because it is cash in transit, we'll debit the cash in transit account. And of course, it will appear as part of the current assets when we do what? The consolidation. When you do what? In this case, the consolidation. We'll likely end up having to consider that what? Cash in transit, cash in transit. So you need to take note, even in any case, there's exactly what you're calling what? Cash in transit. So you'll end up having to deal with it like that. So that's basically, in this case, you'll be able to eliminate that what? Intergroup balances. So in this case, this one will likely be, it was an amount of 800. It was an amount of 800. So we'll less it from the trade receivables, but now we'll end up having to include it there as part of the cash in transit, cash in transit. So that's why you'll be able to deal with this case with the note number 4. Then now in this case, we can go to note number 5, which now in this case calls upon us now in this case to compute what? The goodwill, to compute the goodwill, to compute the goodwill, to compute the goodwill, to compute the goodwill there. So we can be able to determine the goodwill, determination of the goodwill. So hope you've been able to capture this one because I want to now do the goodwill. I want to do the goodwill. I want to compute the goodwill. Have you been able to capture that? So I can see Valerie is asking, can we debit payables, debit cash in transit, and credit receipt? I've told you in this case, you won't do this. So I was just using this. You won't do this. Sawa, you'll do this because there was cash in transit. But if there was no this cash in transit, you would have done this. Sawa, sawa. Are we together, Valerie? Are we together? Yes, that's what I mean. So alternatively, instead of debiting the payables, you would have debited in this case of the cash in transit. So you won't do this, you'll do this because there was cash in transit. But if it was not there, you'd have done this. You'd have debited payables. You'd have debited payables. So like that, like that, like that, like that. So that is what will happen. So of course, remember this one, when you'll be doing the statement of financial position, utaiona, itatokea hapo as part of the current assets. So sasa ile tutaweka hapo 800. So usianze kuuliza teacher, hiyo 800 imetoka wapi? Ndio hiyo. Ile pesa ilikuwa kwa njia inakuja. Ni vile tu bado haijafika, but ni pesa ya kampuni tu bado iko tu hapo katikati kwa njia. Iko tu hapo katikati kwa njia. Iko tu hapo katikati kwa njia. So that is what will likely end up having to happen. That is what will likely end up having to happen. That is what will end up having to happen. So now in this case, we can now compute the goodwill. We can actually compute the goodwill. So determination of goodwill. 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 So we said in this case, you take what? The purchase consideration. The purchase consideration. What was the purchase consideration? What was the purchase consideration? You take the purchase consideration. What was the purchase consideration? Current Paul. Is current Paul here? So as I can see there, 25,600. Our shillings are actually in thousands. So you are dealing with shillings in thousands. We are not dealing with cows for compulsory vaccination. It's 25,600. Then now in this case, of course, for the full goodwill method, I told you in this case, you include here what? The fair value of the non-controlling interest. But here tujapatiwa, so tutapata kwanza in this case, the partial goodwill, then huko mwisho tutaongeza hiyo NCI goodwill ambayo tumepatiwa hapo. The one you've actually been given there of 2.4 million. So in this case, you will less the net assets. You less the net assets acquired. You less the net assets acquired. These net assets acquired, you know, you're acquiring the subsidiary. And of course, I told you the net assets is what? Unaitoa wapi? The net assets unaangalia wapi? I told you the net assets unaangalia wapi? The equity part of the subsidiary. So unaenda hapo kwa the equity part of the subsidiary. Unakuja hapo kwa the equity part of the subsidiary. Ukiangalia if you check the equity part of the subsidiary, you've been given ordinary share capital, which is what? How much? 8 million. You've been given retained earnings of 13 million. 13 million. So therefore, in this case, you'll take the ordinary share capital. You'll take the ordinary share capital. Ordinary share capital. You'll take the ordinary share capital. Ordinary share capital, which now in this case is how much? 8 million. 8 million. 8 million. 8 million. But now there's something. There's something. On the date of acquisition, kuna kitu tumecompute hapo. Kuna kitu tumecompute hapo. Tukasema there was an asset which was actually revalued. Ilikuwa a revaluation of how much? There's an asset which you've actually ended up having to revalue. It is of how much? 2 million. You have to consider that revaluation reserve. Sawa, si kuna mali nimekuambia in working 2. Working 2 or 3? Working 2. You credit the revaluation reserve, 2 million. You debit, in this case, what? The asset account, 2 million. So on the acquisition, there was what? A revaluation reserve, which has just arisen they acquired it because they revalued the assets up. So it means it increased a portion of their equity. Still at the same time, in this case, it increased a portion of their asset. Ilikuwa double entry. Ina affect huko na huko. So unajua inaenda hivyo. So ina increase huko kwa assets, ina increase huko kwa equity. So like that. So in this case, there's a revaluation on acquisition. Revaluation on acquisition. Revaluation reserve on acquisition of how much? 2 million. 2 million. Then we have retained earnings. Retained earnings. Retained earnings tulisema unachukua gani? Retained earnings tulisema unachukua gani? Retained earnings tulisema unachukua gani? Retained earnings, you take which ones? Gideon says asked at the acquisition. Faith says pre-acquisition. Yes, we take pre-acquisition. Sawa. So hapa inafaa sasa ujue pre-acquisition unapata aje. So lazima tupate pre-acquisition. Pre-acquisition retained earnings. Pre-acquisition retained earnings. So of course, these retained earnings you've actually been given there. They are at the end of the year. But kumbuka aka ka subsidiary tulinunua hapo katikati ya mwaka. So in this case, those ones are at the end of the year. It is how much? 13 million. 13 million. And of course, you know what is normally contained of retained earnings. Retained earnings, huwa unazi accumulate. Unachukua zile za last year. You take the ones for the previous year as they brought down. You add the ones you've been able to gain in the current year. You accumulate them. So for us to be able to know how much was the pre-acquisition retained earnings, if you look at, in this case, the income statement, check the income statement. You are told the profit for the year is how much? 6 million. For the entire year, it is 6 million. So it means for 6 months, it is how much? Because in this case, the pre-acquisition period in this year, is how much? 6 months. Is how many months? 6 months. It is 3 million. Exactly. In this case, how much? 3 million. So of these profits of the year, it means we have to less the post-acquisition what? Profits. Of these retained earnings of the year, we'll have to less, in this case, what? The post-acquisition what? Profits. The ones that were there after the acquisition. It'll end up having to eliminate them from the entire retained earnings. Remember, these retained earnings of the subsidiary, they are cumulative. The ones they got brought down from the previous years, the retained profits for the year, they have already added it here. They have added the 6 million here to get 13 million. They have added it to get what? 13 million. So it means we have to minus the post-acquisition so that we can be able to get, before they acquired this subsidiary, how much were the retained earnings. And of course, the post-acquisition period is how much? 6 months. But for the entire year, they made how much retained earnings? 6 million. We have to apportion. Therefore, in this case, we'll take 6 out of 12, which is the post-acquisition period. We multiply by 6 million. So you'll get the pre is how much? Pre is how much? The pre is how much? 3 million. I think it is 3 million. So that is 3 million. That is 3 million. It is actually 3 million. Exactly 3 million. So those are basically the net assets that we have here. The net assets that in this case we have here. It is not 3 million. Sorry, it is 10 million. So after you do that, this one is 3 million. But now when you less from this one, it is 10 million. It is 10 million. It is 10 million. Exactly 10 million. It is actually 10 million. So therefore, in this case, you get a total of how much? You get a total of 20 million. 20 million. You get a portion of how much? 20 million. A portion of 20 million. So for us to be able to know, in this case, the goodwill, that in this case, the goodwill attributable to, in this case, the holding company, the goodwill attributable in this case to the holding company, the goodwill attributable to the holding company, you can change here something a bit. Put here another column. So remove this one and put here another column so that I can be able to explain this one. Put here another column and put now the 25,600 here. You can just remove it here and then put it there. So for us to be able to know what was the goodwill attributable to, in this case, the holding company, we'll now, in this case, take 60% of these net assets. 60% of these net assets, which in this case, you'll get 14 million. I think it is 14 million or 12 million. 12 million, you'll get 12 million. 12 million, like that. You'll less. Then in this case, you'll get a figure of 13,600,000. 13,600,000. So you people are not seeing there. So you'll get a figure of 13,600,000. That is what you'll be able to get there. A figure of 13,600,000. A figure of 13,600,000. Then, so this is basically the goodwill for the holding company. But now, since we're using the full goodwill method, we'll have to add, you'll add the goodwill to the non-controlling interest, which you've actually been given under note number 5, which is a figure of how much? Is a figure of 2,400,000. 2,400,000. And therefore, in this case, you'll get the full goodwill, in this case, you get the full goodwill. The full goodwill will likely, in this case, be 16 million. It will likely be 16 million. So that's basically, in this case, how you likely end up having to compute what the goodwill that in this case will likely be considered in the statement of what financial position. So take note, in any case, you had actually been given the fair value of the non-controlling interest, you would have placed it here. And therefore, this figure wouldn't have actually arisen. This computation of 60% wouldn't have actually been there. We'll be able to see it also in another question. So it means you would have just been able to take that non-controlling interest fair value, you put it here, then you less the net assets as they are. This 20 million, you have just placed it here directly. Because you'd have added here the non-controlling interest, you place the figure here. Then you take these net assets, you add them up to here. The 20 million would have placed it here. But now, since we are using the full goodwill method, and of course, you've actually been given the non-controlling interest goodwill already, so you don't consider it the NCI here. You just, first of all, compute the goodwill attributable to what? To the holding company, which you take the purchase consideration, you less the net assets acquired. Now, in this case, you take 60% of them, you less from the purchase consideration, you get the goodwill attributable to the holding company, you add that one attributable to, now in this case, what? The non-controlling interest. What they mean by NCI here, it is the 40%, the minority shareholders in that holding company that you're having to acquire. What will be the portion of the goodwill attributable to them? It is, in this case, how much you're having to say, how much? 40%. It is actually 40%. It is actually 40%. It is actually 40%. So that's how basically in this case, you'll likely end up having to compute the goodwill attributable to the holding company plus that one attributable to the subsidiary. So like that. So like that. Like that. So that's how basically you'll be able to get what? The goodwill. You'll likely be able to get what? The goodwill. But now, we need to also, in this case, to get the NCI, so the non-controlling interest. The non-controlling interest. The non-controlling interest, we need to be able to get the non-controlling interest. The non-controlling interest. The non-controlling interest. So hope you are through with this so that I can be able to show you how you come up with the NCI. NCI. So this goodwill now, in this case, will appear as an asset in the consolidated statement of financial position. It will appear as an asset. So this is the full method. So this is how you get it. So Missy, this is how you get it. So you know, I'm explaining something here. It is the full goodwill method because, you know, when you talk about the full goodwill method, it is a composition of the goodwill of the holding company and that one of the subsidiary. You take the portions of the two, you put them together. So I've told you in this case, the examiner will do two things. He can either give you the non-controlling interest fair value. Alternatively, he can give you the non-controlling interest goodwill. If he gives you the fair value, not the goodwill, you'll take the purchase consideration, you add the figure here with what? The NCI fair value. Fair value, you put it here. Then what will happen? You take the net assets acquired, which you'll place them here as just the way I've placed them here. Then you less this, you see this 20 million, you'll place it here. Then you less it, you'll get the full goodwill. You'll get this particular figure here. But if you haven't been given that one, first of all, in this case, compute the goodwill attributable to the holding company. This is how you get it. You take now, in this case, the purchase consideration, you less the net assets acquired, that the portion, which is 60%. So that in this case, you can get the goodwill. This one is the goodwill attributable to the holding company. But in this case, you've actually been given the fair value of the goodwill attributable to what? To the subsidiary company, or to the minority shareholders, sorry, to the NCI. So you have to add so that you get full. Full simply means you are considering the goodwill of the holding company and, of course, the goodwill of what? The minority shareholders, which in this case, they are controlling 40% because this holding company acquired 60%. So minority shareholders, you know, they have a stake in this subsidiary company. They have, like in this case, a say, small say. So a portion of this goodwill, they should be able to enjoy it. So the portion they're having to enjoy, it is what you've been given, which is 2,400,000. What you've computed here is the goodwill attributable to the majority, who is the holding company who has acquired what? The subsidiary. This is how you compute it. This is how you compute it. But take note, nimekwambia, in this case, sometimes they won't give you this. They'll give you non-controlling interest fair value. So what you do to get the full goodwill here, you'll take that fair value, you place it here. Then you less the net assets acquired, which means, for example, if it was a figure of 6 million that you are actually given, you'll add it here. Then you take this 20,000, you place it here. What you'll be able to get as the difference will be the full goodwill, which now in this case, you'll be able to do what? Consider as a non-current asset in our consolidated statement of financial position. So that is how you basically get it. So we can now in this case look at now what we refer to as what? The non-controlling interest. The non-controlling interest. We can look at now in this case, there's something we call the non-controlling interest. Non-controlling interest, non-controlling interest, non-controlling interest. So remember, there's something I've just explained a while ago. You know, when the subsidiary, the holding company acquires 60%, when it acquires 6%, there is still 40% that in this case is controlled by the non-controlling, the minority. Is what the minority are controlling in this what? Subsidiary. Is what they are controlling in this what? Subsidiary. And therefore, when you are doing the consolidation, as part of the items of equity, in the combined balance sheet, we have to, in this case, consider what are these non-controlling interests still controlling in terms of the equity part of the subsidiary. So in this case, we'll end up having to compute what we call what? The NCI control or the NCI control. So you know, in this case, there are equity items because in this case, we have the equity items, which is 8 million, 13 million. There's a revaluation reserve of how much? In this case, 2 million. Of these equity items, after the consolidation, after the acquisition, a portion of these, how much are they still having to control? Because it will still be part of what? The equity in terms of what? Consolidating what? The statement of what? Financial what? Position for the two companies. And then in this case, we'll likely compute, I think it's working number 6. Working 6, so we'll compute in this case the NCI control. We'll likely compute the NCI control. So what is the control they still have in that equity? Because you know, the holding company has taken 60% of that equity, but 40% still remains with them. So you have to, in this case, compute what? Their NCI control, because it will appear as one of the equity items in the statement of what? Financial position, the one that has actually been combined. So in this case, you have to get what? The NCI control. So in this case, we'll take the NCI control, because you've actually been told, in this case, you can put your shillings in thousands, your shillings in thousands, like that, shillings in thousands, like that. So we have, in this case, the ordinary share capital. Ordinary share capital in that subsidiary. So because you want to get what the NCI will be controlling, it is 8 million. It is 8 million. In this case, we have what? We have that revaluation reserve. You remember it, the one you've just used a while ago. Revaluation reserve increased part of their equity items by 2 million. By 2 million. Then in this case, we have what? The retained earnings. We have the retained earnings. We have the retained earnings. We have the retained earnings. These retained earnings is just the ones you've actually been given, is 13 million. So you want to know how much are they controlling of these retained earnings. But take note that these retained earnings were actually affected. They were actually affected. After you done the adjustments, they were actually affected. One of the items was, in this case, what? It was unrealized profit. I think it was URP. Unrealized profit, was it depreciation undercharge? It was URP of 800. And of course, in this case, you had what? Depreciation undercharge on revaluation, which was an amount of how much? 200. So it means these retained earnings they have by the end of the year, after, in this case, what? The adjustments on acquisition, they won't still remain the same. They would have actually done what? Been affected. So these retained earnings of what? Of the subsidiary would actually be affected, because there was what? Unrealized profit on what? Closing stock of how much? 800. And of course, now in this case, depreciation undercharge of how much? 200. So these were expenses. And in fact, in this case, you're having to say they'll basically affect what? The cost of sales. So it means they'll end up having to affect what? The retained earnings at the end of the day, by the end of the year. So in this case, we'll end up having to less them 800. And of course, how much? 200. You can write somewhere. I don't know how you write. You can write this is URP. This is depreciation on revaluation or something. You can write so that you can remember. You don't forget. So it means in this case, our retained earnings by the end of the year, in this case, would have reduced from that 13 million. It would have become how much? 12 million. It would have become 12 million. Yes, 12 million. It would have become 12 million like that. So in this case, it means the total here comes to how much? So this is 22 million. 22 million. But remember, this non-controlling interest, remember this one is like full, the entire subsidiary retained earnings or equity or portions for the subsidiary company. But they are only controlling 40%. They're only controlling 40%. So 40% of this one comes to how much? Remember, this is the equity portion on after acquisition. But now they're not controlling 100%. The 60% goes to those other guys, which basically in this case, you're having to consider when you are doing what? The consolidation. But the NCI now, in this case, in the part of the equity, will likely go to the non-controlling interest. It is how much? 8,800. 8,800. So in short, what we mean here, when we'll be coming up with the consolidated financial statement or financial position, we have to know what are the non-controlling interest controlling in the subsidiary. What they are controlling will still remain as part of the equity for the entire group. Will still remain as part of the equity for the entire group. And therefore, in this case, this NCI will appear as part of the equity items in the statement of financial position. So that's basically how you get what the NCI are having to do what control. You take the equity portion of, in this case, the subsidiary. In any case, there are any, for example, adjustments, you make them. For example, revaluation reserves, you make them. If the retained earnings were affected by this kind of items, you effect them. Then you know by the end of the year, what were the portions of what? Of equity. You take the minority control, the NCI control of that portion, which now in this case becomes what? The NCI of the group. So in this case, it will appear as a NCI of the group. In this case, in what? In the equity part of the statement of what? Consolidated statement of financial position, when you're having to do what? Consolidate. When you're having to do what? Consolidate. So with this kind of adjustment, then in this case, we can be able to come up with what? The final statement. So the final statement will likely be very fast because I've been able to explain in detail. I've been able to explain in detail what you likely end up having to do with those with those adjustments. So I think we can be able to now in this case come up with now the statement of comprehensive income. Then we come up with what? The statement of financial position. Statement of financial position. So let's do it. So we have in this case, our question is for consolidated statement of comprehensive income. So we can have in this case, hope you'll be able to see here. You're not able to see there. I think here. So P Limited. We can say P Group. You can say P Group. Statement of income. Statement of income for year ended 31st of March 2015. 31st of March 2015. Then we can now in this case have our shillings in thousands. We can have our shillings in thousands. So in this case, we have revenue. We have revenue. So revenue in this case, you'll add them line by line. If you go to the statement of income, we have in this case 170,000. 170,000. But remember, in this case, you're having to say those ones of the subsidiary, because the subsidiary was not actually in existence for the entire year. It was only for 6 months. We have to do what? The apportionment. So in this case, it will likely be plus 6 out of 12 times 84 million. 84 million. But of course, there's another adjustment we need to be able to make on these ones. Huh? What do we adjust on these ones? There's another adjustment you need to make on this revenue. What is it? The intergroup sale of how much? 8 million. So it's our 8 million. intergroup sale of 8 million. When you do that, how much do you get? The intergroup sale of 8 million, we have to eliminate it. It is under a certain working there. It is under a certain working there, or it is under note number 3. It is under note number 3. So when you do the computation, how much do you get for the revenue? You have the cost of sales. So the cost of sales in this case, we have 126 million for the holding company plus 6 out of 12 because the subsidiary existed for 6 months, multiplied by, in this case, 64 million. 64 million. 64 million. So this one you get how much? What is the figure you're getting there when you do that? So in this case, we have adjustments here. We have adjustments here. We have the unrealized profit of 800. We have, in this case, the depreciation undercharge of 200. Then you have, in this case, the intercompany sale of 8 million. We less it. We less it. Remember, when we were doing the workings, I told you need to remember. Don't forget. Don't forget. Don't forget. Don't forget. So that's how you'll do it. Then we have, in this case, you'll be able to get the gross profit. The gross profit. So what is the figure you get for revenue? What is the figure you get for revenue? Revenue. Karen Paul, what is the figure for revenue? The figure for revenue? What is the figure for revenue there? $240 million. 240 million. 240 million. I can see 204. Which is which? 204. 204 million. 204 million. What about for cost of sales? 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 So you take 126 million, you add 6 out of 12 because the subsidiary was in existence for 6 months. You multiply 64 million, which is the cost of sales for the subsidiary, but you make the adjustments. We have, in this case, unrealized profits, depreciation on revaluation. You eliminate the intercompany sale. You're getting 151 million. So 151 million. 151 million. So that means the gross profit is how much? The gross profit is how much? That means the gross profit is how much? It is 355. 355. 355. So 204 million minus 151. 53 should be 53. 53 million should be 53 million. Should be 53 million. 53 million. Then in this case, we can go to just the income statement. So you can now, in this case, consider distribution expenses, less expenses. You less the expenses. So the first one you have in this case is distribution expense, which in this case is 4 million. So 4 million plus 6 out of 12 multiplied by 4 million. Then you have, in this case, administration. We have admin expenses. So we have, in this case, 12 million plus 6 out of 12 multiplied by 6.4 million. 6.4 million. 6.4 million. Then in this case, we have what? Finance cost. So these ones didn't have any form of adjustments. You can see these ones are the ones you can just be able to pick directly and you score your marks. As in Mambo Mingi, they don't have any form of adjustments. So you just basically place them as they are. So 600 plus 6 out of 12, you multiply by, in this case, 800. 800. So this is 6 million. This is 6 million. This is how much? 3,200, 15,200. This one is 15,200. This one is 600 plus 400. This is 1 million. 1 million, like that. So you get the profit before tax. Profit before tax. Profit before tax. You get a figure there. You get a figure there. The profit before tax, you get how much when you do the computation? Profit before tax is how much? Profit before tax. Profit before tax. 30,800,000. So 30,800,000. So the profit before tax is 30,800,000. Then you can consider the tax expense. So the tax expense, income tax expense. So the income tax expense. So you have in this case 9,400,000 for the holding company, then 2800 for the subsidiary. So 9,400,000 plus 6 out of 12 multiplied by, in this case, 2,800,000. So how much are you having to get for the tax expense? For the tax expense, I think it will be 10,800,000. 10,800,000 you less. So it should be able to give you the profit after tax, the part. It should be able to give you the profit after tax, which is actually 20 million, exactly 20 million, which is actually 20 million, which is actually in this case 20 million. You get the part. Get the part. So the profit after tax, you'll actually get the profit after tax. So the profit after tax, profit after tax. Profit after tax of, when you do the mathematics, they should be able to give you 20 million. 20 million. Like that. So those are all the adjustments. You can see some of them are just direct. So some of them are just direct. And of course, the examiner will end up having to give you a mark for them. You'll get a mark for them. So there are like 10 entries here. So where each entry you make a mark, get a mark. You can see some of them don't need adjustments. You just pick them the way they are, you combine them. So you can not end up having to score 0. If you are a very clever student, you'll score some of these marks without having to do those adjustments or workings. So of course they are very important, but for some of the figures are just direct. They don't have any form of adjustment. You can be able to just place them the way they are, and you can easily be able to do what? Score the mark. You can actually easily be able to score the mark. Then of these profits, we have in this case profit after tax of how much? 20 million of 20 million. So we can in this case get the one that is actually attributable. You can get the ones attributable to non-controlling interest. The profits attributable to non-controlling interest. Non-controlling interest, see, I've already explained in detail. They are the minority, the ones who don't have like a major stake or control of the company. The holding company is one that has what? A control, because it is controlling what? 60%. Of these profits, not all of them will likely go to what? Not all of them will likely end up having to go to what? To the holding company. But in this case, some of them will go to the minority who are what? 40%. So it means in this case, for us to be able to get this portion, we can take 40%. What was the post-acquisition profits for the, what was the post-acquisition profits for the subsidiary? What was the post-acquisition profits for the subsidiary? What was the post-acquisition profits for the subsidiary? According to you, what was the post-acquisition profits for the, it is 3 million. Because you see the profit for the year, if you look at the income statement for the subsidiary, the profit for the year you've been told is how much? 6 million. So it means because this subsidiary existed for 6 months, the after acquisition, the profit was actually half of that. So 6 million multiplied by 6 out of 12. It was how much? 3 million. It was how much? 3 million. So now in this case, we can be able to take 40% of this 3 million. But this 3 million was actually affected by what? By unrealized profit. Also what? Depreciation undercharge. And therefore, in this case, it means what was attributable to them. What was attributable to them? If we do this mathematics, this one is 2 million by 40%, which comes to 800. It means the remaining portion of the profits will likely go to what? To the parent or the holding company. So attributable profits to the parent or the holding company will be the difference, which now in this case is 19,200. 19,200 like that. This one will go now to the holding company because it is controlling how much? 60%. So for the non-controlling, they'll take this portion. The minority shareholders will take that portion, but the 60% control, they'll end up having to take what, 19,200, which is the parent company or the holding company, which acquired what, 60% in the subsidiary. So that's what will likely end up having to do what happen there. Will end up having to happen there. So it means they'll pay dividends out of this to the holding company, or maybe this is dividends out of this to the minority shareholders. So that's how you come up with what? The income statement. Now, 1,009, in this case, we come up with the statement of financial position. So hope you are through. Are you through writing? Are you through writing so that we can be able to quickly look at the statement of financial position? Are you through? I want to wrap this. I want to wrap. So confirm whether you are through. So I want to wrap it. So you can always indicate these ones. You'll forget. Nekesa, you'll forget. This one is unrealized profit on closing stock. This is depreciation on revaluation. It affected the retained earnings of the subsidiary after acquisition because their assets were revalued. Part of the items they were sold to were still in stock. So we realize in this case what URP on them. So hope you are through because I'm wrapping that one. I'm wrapping that one. So we want in this case to look at the statement of financial position. Statement of P group statement of financial position. Year ended 31st of March 2015. 31st of March 2015. And then in this case, you can put your shillings in thousands like that. So we can start with the non-current assets. Non-current assets. You can start with the non-current assets. We can start with the non-current assets. Non-current assets. Non-current assets. So the non-current assets, them you don't apportion. Nekesa. So don't go there and you start putting 6 out of 12. Sawa. So Karen Paul, don't go there and start putting 6 out of 12. No, you don't apportion. You just add them line by line the way they are. You don't apportion the assets. You don't apportion them because they were acquired. You don't actually apportion them. Don't apportion them. What you do, you combine them. You just combine them the way they are. So in this case, you go to the non-current assets. You have what? Property, plant, and equipment. So property, plant, and equipment, you have in this case for the holding company, which is actually 6,900. We add that one for the subsidiary, which is 18,900. We'll add what on this? We'll add how much on this? We'll add how much on this? We'll add 2 million, the revaluation. You still remember it. But now in this case, you also less what? How much? We less how much? We less how much Musioka? We less how much Valerie? We less how much Valerie? We less 200. The depreciation, this revaluation, they depreciated it. So we less 200. We less 200 like that. And of course, you'll be able to get that figure. Then we go to, in this case, what? Investment property. Investment property. We get investment property. So this one didn't have any form of adjustment. So you just basically pick the figures as the way they are. You can see how we get free marks here. That's easy marks here. They don't need any form of adjustments. And you're smiling all the way. You get 26. This one you get 26,600. 26,600. What about in this case for PPE? PPE unapata ngapi? When you do the computation, 6,900 plus 1,800 plus 2 million. Minus 200, 81,600. You're getting 81,600. Hope it is correct. 81,600. There's another item we'll add here. What do you think it will be? There's another item you're going to add here. What do you think it will be? Ruth, what will it be? Goodwill. It will be goodwill. Remember, the teacher was singing, goodwill will appear. Goodwill will appear as part of the non-current asset. It was like a song. Now you can be able to see it. How much was it? Byron? How much was it? It was 16 million. It was 16 million. And of course, we would have been able to complete what? Our non-current assets. And therefore, in this case, we can go to the current assets. We can go to the current assets. We can go to the current assets. So for the current assets here, as per the TIO balance, we have in this case what? Not TIO balance, but that SFP. We have inventory, receivables, and of course what? Bank. So inventory. So of course for inventory, in this case, we have 12,080. You add for the subsidiaries 5 million. Then we do what? We do what, Valerie? We do what? Inventory 12,080 plus 5 million. Then we do what, Valerie? Byron, we do what? Then we do what? We do what? Then we do what? We do what? We less the U. Is it UPS? That's URP or that one? That one. Is it 800? It was how much? 800. So we less 800. Don't forget. Don't forget. Don't forget. Don't forget. Don't forget. So you'll get in this case 16,280. 16,280. Then we have in this case trade receivables. We have in this case receivables. We have receivables. So for the holding company, it was 11,920. For the subsidiary, it was in this case 4,900,000. Then we do what? Then we do what? Then we do what about it? We do about what about it? Someone says we add intergroup. We add intergroup. Someone says we less 800. Karen Paul, do we less 800? What is that 800? Do you know what it is? Do you know what it is? Do you know what it is? What is that 800, Joseph Okot? What is it? What do we call it? We call it an intergroup balance. Sawa. We call it an intergroup balance. So we less in this case 800. We eliminate it. It is as per not number 4. Not number 4. Not number 4. Ujue hizi vitu kama utaki usahau pia unaweza kuwa pia unaandika iko by the way iko kwa note gani. So it is this one is as per note 3. This one is as per note 4. Note 4. So when you less, you'll get a figure there. You'll get in this case 16,020. 16,020. So this one is as per note 3. This one is as per note 4. Note 3, note 4. This one is as per note 2. This one is as per note not what? Not 2 also. Not 2 like that. So usianze kurevise nekesa alafu uanze kuuliza na hii 800. Hii 800. Hii ilitoka. Where did mwalimu get this one? So you can indicate so that when you'll be revising it will be easy. So this one is as per note 3. This one is as per note 4. Of course, you need to remember the entries we talked about, the special transactions. So bank, it doesn't have any adjustments. So in this case, it is 8 plus, in this case, 3,300. So you'll get in this case 11,300. 11,300. What else will we add here? What else will we put there again? What else will we put there again? What else will we put there again? Cash in transit. That is what I wanted you to tell me. Cash in transit. Cash in transit. You are the most brilliant students I've met in the year 2025. The most brilliant people I've met in the year 2025. Cash in transit. You can be able to remember it. Mwalimu was singing about it. And he told us we won't be able to adjust the trade. We won't be able to adjust this one with the trade payables, but we'll consider it here. We'll likely consider it here. And therefore, in this case, it will be the cash in transit, cash in transit, cash in transit. I think those are the only. Not to forget this one, you can put there note number 4, sawa. So that ukirevise, usianze kupigia mwalimu kabla ujue hiyo note iko wapi. Only call mwalimu if you've been able to look at that note. Note number 4, that in this case, you don't know where this 800 was coming from. It is coming from note number 4. If it happens, there was what? A cash in transit. You consider it here. You consider it here. You consider it here. And of course, those are the only what? Items. So you can go in this case to on the part of, we can go to the part of equity and liabilities. We can go to the part of equity and liabilities. To the part of equity and liabilities. To the part of equity and liabilities. Are you through? Are you through? You can add What are you getting there? What are you getting there? Try to add them. Try to add them. Try to add them. Try to add them and tell me the figure you're having to get. Just add them. Just add them and tell me the figure you're getting. You're getting 168,600. So 168,600. Valerie, is that true? Ruth, is that true? Ruth, is that true? 168,600. So hope you are through with that, because I want now, in this case, we now look at the other side of equity and liabilities. 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 And then in this case, we can start with ordinary share capital. Ordinary share capital. Ordinary share capital. So for ordinary share capital, Ruth, for ordinary share capital, you only consider those equity items of the holding company, because you remember these equity items for the subsidiary, we've really used them when you are computing what goodwill. So they won't come here. They won't come here. You'll just, in this case, majorly consider those items of equity of the holding company. In that case, they have, for example, any adjustment, you likely end up having to do what to consider those adjustments. For example, for the ordinary share capital, of course, you are told it is 20 million. It is 20 million. But we'll add how much? It is 20 million, but we'll add how much? Valerie, it is 20 million. That is what you're having to see. That is what you're having to see in the statement of financial, but we'll add how much? We'll add 3,200,000. Remember our working one. When they sold the shares, what went in this case to, when they bought the shares, what actually went to what? To the equity? It was 3,200,000. Remember that entry? So 3,200,000. So we'll add that 3,200,000. So you'll get, in this case, you'll get 23,200. Then there was also an item of share premium. Remember that same working share premium, we got it there. It was an amount of, share premium was an amount of 22,400. Share premium ilikuwa ngapi msioka? 22,400. It was 22,400, 22,400. Then we can, in this case, consider there's the retained earnings. There's the retained earnings. There's the retained earnings. Retained earnings. So that retained earnings, it has a working, which I don't actually done it. Retained earnings. So we have, in this case, retained earnings. So for the retained earnings, if you look at what you've actually been given there, is actually 70,800,000. 70,800,000. 70,800,000. 70,800,000. I don't know, you can put a working somewhere. You can put a working somewhere. So hope that one is okay. You can put another working. So just put another working. I don't know if it will be working 7 or something. It will be working 7 or something. I don't know. So the retained earnings. Retained earnings, how do you get it? Retained earnings. You'll get, in this case, the parent retained earnings. Parent retained earnings, which in this case, you've actually been given a figure of 7,800. 7,800. You people are not seeing there. So 7,800, 7,800. So you're seeing a figure of 7,800. So that's what you are seeing there in the statement of financial position, 7,800. But now you'll add the post-acquisition share. So the post-acquisition share of retained earnings of the subsidiary. Post-acquisition share of the retained earnings of the subsidiary. So this one, how you'll be able to compute it. Remember, this holding company is controlling 60%. So you'll take 60%, 60% of the post-acquisition retained earnings, which of course is 3 million. Sawa. It is 3 million. It's 3 million. So It is, you know, it is 6 million for the entire year, but the post-acquisition period is half of that. It is 3 million. So 3 million. But now this 3 million, what will we adjust it with? Ruth, what will we adjust it with? This 3 million. So try to think, try to think, try to think. You need to open up your mind and explore. Your mind needs to explore. So this 3 million, will adjust it with what? The depreciation and what else? The URP, unrealized profit, sawa. And so you adjust it with 800 and of course 200. So therefore, in this case, you'll get a figure of 1,200. So this one is 2 million by 60% is 1,200. 1,200. So you'll add, you'll get in this case 72 million. You'll get 72 million. So you'll get 72 million, 72 million, you get 72 million. And therefore, in this case, our retained earnings that we'll have as part of the equity items will be 72 million. So you normally do that retained earnings like that. You take the retained earnings of the parent, then you take the post-acquisition share of the retained earnings, you add on it so that you can be able to know how much were the retained earnings that were acquired, plus those ones of the subsidiary by the end of the year, which will be parts of the equity items. That's how you get that particular figure. Then there was also in this case a figure we computed of what non-controlling interest, and you remember me having to tell you that it will likely appear as part of the equity items. The NCI, it was how much? That non-controlling interest, it was how much? The NCI, Kathy, you remember it? You remember that working of NCI? And of course, I was having to, in this case, tell you it will appear, it will appear, it will appear. Was it 8,800? Was it 8,800? 8,800. Was it 8,800? How come it was 8,800? Kwani we didn't do the working as expected. Yeah, so there's something I actually forgot to add on it. There's something we actually forgot to add on it. So I can see you're saying 8,800. It was, of course, 8,800, but just on the same working, sorry, I forgot to tell you, there's on the same working, you'll add, just on the same working, there's that 8,800 we got, that 8,800 we got, you write like this, just write like this after that 8,800, add, you say add the NCI, you add the NCI goodwill, you add the NCI goodwill on it. The NCI goodwill which you've actually been given is actually 2,400,000. 2,400,000, and therefore in this case, remember this one is like an asset that in this case, they'll likely end up having to control. So in this case, it will likely be 8,800 plus 2,400,000. You'll get 11,200,000. 11,200,000. So you'll add goodwill on it to get 11,200,000. And therefore, in this case, our NCI here will likely be 11,200,000. 11 million. So just go on the same working. So the one we had actually done for NCI, we are supposed to add the NCI goodwill of 2,400,000. You'll get a total figure of 11,200,000. And therefore, that is what we'll actually end up having to recognize as the NCI under equity and liabilities. So we need to add the NCI of the goodwill. So those are the only equity items we have. Then we can go now in this case to the non-current liabilities. Non-current liabilities. Non-current liabilities. I can see Valerie says R. I don't know what you mean by RR. What do you mean by RR? So you can go now in this case to the non-current liabilities. Have you gotten it, Valerie? So you know, confirm whether you've gotten what you're having to say. Revaluation reserve or revaluation reserve? Revaluation reserve, I can see you asking about the revaluation reserve. But remember this revaluation reserve, so remember we considered it when you are computing the NCI. You remember it's there, so it was there. Just on the same working, I've been able to tell you adjust this one. You see on the same working, I'm telling you adjust this one. We've considered it there, so we won't consider it again. Sawa. Edwin, you've seen it? Just on the same working, I've told you adjust this one. There's that revaluation reserve. In this case, I've been able to tell you you add as part of what? So we won't end up having to, for example, in this case, do what? Consider it again. Sawa. It is part of this what NCI that you've actually been able to compute. So it won't be there. It is there. Equal up and down. So it is there. So we won't actually end up having to consider it here. it would actually end up having to consider it here. Consider it here. We won't end up having to consider it here. I can see Daniel says part of goodwill. No, Daniel. You see that same working, if you see that same working, there are 3 items there. Before you get the 8,800, there is, in this case, ordinary share capital 8 million, revolutionary reserve 2 million. Then in this case, you have retained earnings, which in this case is 12 million. The pre-acquisition retained earnings is actually how much? 12 million. The retained earnings for the company, sorry, is actually 12 million. So we've considered it there. So then in this case, we've actually been able to get how much? 22 million multiplied by 40%, which is 8,800. But now we have to add what? The NCI goodwill, which will come to 11,200. So now we can get the non-current liabilities. Non-current liabilities. You can get the non-current liabilities. So for the non-current liabilities, those ones, they don't have issues. So they're just the way they are. Non-current liabilities. Non-current liabilities. So in that, you have the 10% loan note. So you'll add them. So it was in this case 6 million plus 8 million, which in this case you'll get 14 million. We'll get 14 million. Then you have in this case the current liabilities. Current liabilities. You have the current liabilities. So for the current liabilities, we have also 2 items. We have in this case payables. So payables, they are just the way they are. Remember, we won't adjust them with that cash in transit. So they'll just basically remain the way they are. It is 12,300,000 plus 7,050,000. 7,050,000. 12,300,000 plus 7,050,000. You'll get 19,350. So remember, this one is the 10% loan note. So for the 2 of them, it is 6 million plus 8 million. You get 14 million. Then you have, in this case, the current liabilities. One of them is the payables. It is 12,300,000 plus 7,050,000. We won't adjust it with that intercompany balance because there was a cash in transit the subsidiary had already paid. So it means in this case, we won't adjust it. But in another case, there was no that cash in transit would have lessened the amount here. But now in this case, it just remain the same. So it is 19,350,000. Then the last item is accruals. Is actually accruals. The last item is actually accruals. The last item is actually accruals. So hope you can be able to see there. So you can be able to see up to there. So it is still okay. So the last item is actually accruals. You can put accruals. The last item is actually accruals. Accruals, they are just also the way they are. There's no any form of adjustment on them. Accruals, you add them, it is actually 4,100,000. You add, in this case, 2,350,000. So you'll actually end up having to get 6450. 6450. 6450. So like that, 6450 like that. So you can add the totals. You can add the totals. You can add the totals and give me the figure. Give me the figure of the totals like that. So I can see Nekesa has already gotten the total, which is 168,600. So 168,600. 168,600. 168,600 like that. 168,600 like that. So that's what basically in this case you do what you do that computation. So I've really taken my time. So just in this case for you to be able to comprehend, I didn't want to rush. That's why I've just gone very slowly. So any question you might be having, you can be able to ask. You can be able to ask, but I'm going to give an example, and not an example, but kind of like an assignment. You do it. Kind of like an assignment. You do it. But the question you'll likely be handling next will likely comprise of, in this case, a subsidiary and an associate. And of course, you said for an associate, it will likely be comprised of the holding company having acquired 20% up to a stake of 49% in that other company, which now in this case becomes what? An associate. So there'll be 3 companies. One of them will be a subsidiary, then the other one will be an associate. So how do you in this case end up having to include what? An associate when you are preparing the group accounts? Whereby in this case, we'll be able to say we use what we call the equity method. the equity method. So briefly, in our next class, before we start, I'll write something brief about what the equity method of having to do what, in this case, prepare group accounts for companies that include what, an associate. So I use the equity method, in this case, what, prepare group accounts for groups that are having to include what, an associate. So we look at the equity method, see basically what is the format regarding the income statement, and what is the format regarding, in this case, what, the statement of financial. And then, of course, in this case, we'll be able to do what, the illustration. So it won't take long. So we'll be able to do that illustration for, in this case, an associate included. So there'll be 3 companies like this, A, B, C. This one is a subsidiary. This one is an associate. So how do we, in this case, end up having to do what? Prepare the group accounts. How do you prepare the group accounts? It's a bit difficult to maneuver the LMS videos without what topics. So I'll be able to, I'll label them by tomorrow morning. I will label them by tomorrow morning. But I hope all the videos have actually been uploaded. So they should be following each other. So I think the last like 4 or 5, I haven't indicated the topics, but I think I'll be able to indicate there which are the topics having to be handled. I think that will likely be okay. So I'll give an exam and kind of like an assignment. You can be able to try and actually attempt it. See whether you can be able to comprehend what we've just been able to learn, just for your own practice, Then when I come in the next class, we'll actually be able to now, in this case, understand how you deal with an associate, when you're having to prepare what, group accounts. I think that will likely be okay. So I can encourage you and have a positive attitude towards this particular topic. It will likely be okay. It is mandatory. It will be in the exam. It is mandatory. It will likely be in the exam. So you better comprehend it so well. Otherwise, thank you very much. And of course, you can have a good night. Let's catch up on Thursday. On Thursday, we can catch up. The assignments I'm going to share on the group. So you'll see it. I'm going to share on the group. The assignments I'm going to share on the group. Sawa Augustus. I'm going to share on the group, then you can practice. You can practice with it.